Assalamu alaikum friends. So in this second video we shall see the valuing accounts receivable part of this chapter, and this concerns the by valuation we mean the measurement of account receivable towards the end of the period. So we saw in the previous video how to measure the account receivable when it is actually incurred or it is when actually recognized first time in the books. So it increases by the sales revenue or service revenue, it decreases by the sales or service revenue returns or discounts or things like that. Now, uh, how to show the accounts receivable towards the end of the period, end of the reporting period in the balance sheet. So the main problem which underlies to address at this point in time is whether we are going to collect all the account receivable which are shown on my balance or shown on my ledger accounts. For example, the big companies may have millions or billions of rupees or million or billions of dollars in their accounts receivable. So are all of them going to be collected? And the past practice says that some portion of them might not be collected because some customers will not pay because they get bankrupt or they are poor in their financial performance, or they disappear from the market. So there are two methods basically to cater for this situation. The first method is known as the direct write-off method. So the direct write-off method, under this method, when a company determines a particular account to be uncollectible, so this is important, right? When we get sure that a particular customer is not going to pay because we get the confirmation that the customer has gone bankrupt, or if we get to know that the customer has disappeared, or something else which actually confirms us that we are almost sure that this account is not going to be collected, then we record an accounting entry to remove that account receivable from our books. So the entry is we debit an expense account, which is known as the bad debt expense or uncollectible expense, and we credit the accounts receivable. So asset is decreased, so decrease in asset is recorded as a credited account receivable, and corresponding debit whenever an asset decreases because of the business activities, so this becomes an expense. So this is an operating expense, so we title it as bad debt expense or uncollectible expense. Keep in mind that one may think that this bad debt expense should not have been debited, rather sales revenue or sales return or things like that could have been debited, because this is reduction in sales. Because account receivable was originally increased by sales, so when the customer is not paying, then actually it is my sales revenue which is reducing, so we should debit some contra revenue account. But accounting standards see it differently. They say that an uncollectible expense is a necessary expense whenever you sell goods on credit. So it's almost sure that some part of the receivables will not be collected. So it's not reduction in revenue, it is rather another a different expense. So they require that you record them as a different expense. So that's why we debit an expense. So we know that whenever expenses are recorded, they are debited, and if we would have recorded as a reduction in revenue, then also that would have been debited. So bad debt expense is debit, account receivable is credit. This happens when actually our we know to we get sure that some customer is actually not going to pay. So these shows the actual losses, right? So if somebody asked why you have received credit this account receivable 1600, then we can actually show. So let me show you. We can actually show that out of this 60, my total account receivable. So say my accounts receivable are party A receivable is 5,000, and party B receivable is 2,000, and party C receivable is 1600, and I got to know that this is the account which I'm not going to receive. So maybe my total account receivable would have been at this point in time would have been 8,600, and then when I created 1600, as we saw in this entry, so my account receivable will decrease to 7,000. So if somebody asks me why you have reduced by 1600, we can show that it is customer C, and he has gone actually bankrupt, so we are not going to receive this amount. So that's why this is known as the direct write-off method, when we actually got to know that this customer is actually not going to pay. It's not necessary this is the full amount. It's also possible that customer C comes to us and say, okay, receive this 600. So he pays us 600, and then he says, I don't have any extra money, I have gone bankrupt. So maybe in that case, we will credit account receivable by just 1,000. So that amount doesn't necessarily belong to one single customer, this can belong to two customers, three customers, this can belong to part payment of a customer, as I just said. That maybe if C says that C pays us 600 and then 1000 has to be written off. So this is the direct write-off method. Now keep in mind this direct write-off method, what happens? Under the direct write-off method, companies often record bad debt expense in a period different from period in which they record the revenue. So because the sale, so when we would have recorded the sale revenue of this customer, we would recorded sales revenue of this customer most likely in some previous periods, right? Because the customers went bankrupt some time after they have actually bought goods or services, got services from us. So we get to know sometimes even after a year that this customer is not going to pay. Before that, we keep on following up, please pay, please pay, please pay. But the customer keep on deferring. And finally, we got to know that the customer is not going to pay. So it means that the sales revenue was recorded in the last period and its bad debt expense actually is recorded in the next period. So maybe the sales revenue of 2022 and the bad debt expense corresponding to that sale. So this expense 1600 should actually relate to the sale of 2022 but it's recorded in 2023. So this is what the author says and the accounting standard says that this method does not attempt to match bad debt expense to sales revenue in the income statement. So a very important accounting principle is the matching principle, which is one wing of the accrual basis, which says that if some expense pertains to a particular revenue, both of them should go to the same income statement, right? Same year income statement. Now what happens over here is that the sales revenue of customer C, when we would recorded customer C's sale, that is the account receivable debit and sales credit, would have gone in 2022. Whereas the bad debt expense, as we saw, it actually we got to confirm that the customer is not going to pay. So it is recorded in 2023. So the sales, the revenue goes to the income statement of 2022, whereas the expense goes to the income statement of 2023. So this is accounting standard. This is not matching. Expense goes to the same year. So how can now my plea that how can I know got to know in 2022 that customer C is not going to pay? So then accounting standards say yes, you are right. So that's another way. So that's way is actually known as the allowance method, which we will see in the next video. So consequently, unless bad debt losses are insignificant, the direct write-off method is not acceptable. So this method we were discussing is the direct write-off method. We are actually writing off the account receivable, removing account receivable from our books, crediting it. It is actually writing off of account receivable. So this, unless bad debt losses are insignificant. Insignificant means if my bad debt losses are maybe 0.001% of my total receivable, then it's okay. I can do this way as well. Accounting standards say they don't mind, right? It's not material. It's not going to impact the decision making. But if it is 1% of receivables, if it is 2% of receivables, if it is 5% of total receivables on average, right, based on my past history, then accounting standards say that this is something not acceptable. So for example, over here you see this is almost more than 10% of the receivables, right? So this method is not acceptable. Then what we do, they say it is the allowance method which you have to follow, so which we shall see in the next video, right? Thank you.